In 22,000, a leaked collection of IRS data showed something that surprised a lot of people. Some of the wealthiest individuals in the country were reporting very low taxable income relative to the scale of their wealth. They were not cheating, they were not hiding anything. They were using a strategy that is legal, documented, and has been discussed in tax literature for decades. What that strategy reveals about the difference between how labor and assets are treated by the tax code is what this video is about. Understanding why that is possible reveals something important about how the financial system actually works at scale. And the answer is not what most people expect. It is not a loophole. It is not a conspiracy. It is not something the IRS is unaware of. It is a structural feature of the tax code that has been sitting in plain sight for decades, publicly documented, legally codified, widely discussed in academic and financial circles. The reason most people have never thought carefully about it is not that it was hidden from them. It is that it only becomes relevant at a scale most people never reach. The strategy has a name: buy, borrow, die. And understanding it step by step changes how you see the relationship between wealth, assets, and taxation in this country. Let us start with the model most people operate inside. You earn money through work, you pay income tax on it, you save what remains, invest it over time, and watch it grow. When you need liquidity, when you want to fund retirement, cover a large expense, or simply access the value you have built, sell. You convert the investment back into cash. And at that moment, the government calculates what you made and takes its share. This is called a realization event. The gain becomes legally real the moment you sell. Before that moment, the growth is unrealized. It exists on paper, but it has not been converted in anything taxable. The tax code, by design, does not tax appreciation until it is realized. Until you sell, nothing is owed. That single principle, that gains are taxed on realization, not on accrual, is the foundation of everything that follows. Now, here's the contrast that changes everything. Loan proceeds are not income. When you borrow money from any lender, that money does not count as taxable income under the tax code. You received cash, yes, but you also incurred an obligation to repay it. The IRS treats it as debt, not earnings. No realization event occurred. Nothing is triggered. Two facts sitting side by side. Selling creates a taxable event. Borrowing does not. If you own assets that have appreciated significantly, those two facts open a door that most people never encounter. Instead of selling the assets to access cash and triggering the capital gains tax that comes with that sale, you can pledge those assets as collateral for a loan. The lender gives you liquidity. Your assets remain in place, no sale happened. No gain was realized, no tax bill was created. Your portfolio keeps compounding. Loan gives you cash to spend, and the tax on decades of appreciation simply does not exist. Not yet. Possibly not ever. This is the borrow component of the strategy. And on its own, it is already a meaningful structural advantage. But the strategy does not fully close until death. And that is where it becomes something else entirely. Under Section 1014 of the Internal Revenue Code, when someone dies holding appreciated assets, those assets receive what is called a step up in basis. To understand why that matters, you need to understand what basis means. Basis is the cost of an asset for tax purposes. It is the starting point from which gains are measured. If you buy stock for $10,000 and it grows to $200,000, your basis is $10,000. If you sell, your taxable gain is the difference, $190,000. When an asset is inherited, the heir's basis is not the original purchase price. Under the step-up rule, it is reset to the fair market value at the time of death. So if that same stock, purchased for $10,000, now worth $200,000, is passed to an heir, the heir's basis becomes $200,000. If they sell immediately, their taxable gain is zero. The $190,000 in appreciation that accumulated over a lifetime is, for capital gains purposes, permanently erased, not deferred. Erased, the loan taken against those assets during the owner's lifetime gets settled through the estate. The assets may be sold to repay the debt, but because the basis was stepped up at death, that sale generates little or no taxable gain. The debt is resolved. The appreciation disappears from the tax calculation, and the next generation can begin the cycle again with a clean basis. Buy appreciating assets, borrow against them instead of selling. Hold until death. Pass to heirs with a fully reset basis. Now it is worth being precise about what this is and what it is not. This is not a loophole in the sense of an unintended gap that clever lawyers found and quietly exploited. A realization principle, the rule that gains are only taxed when you sell, is a deliberate feature of the tax code. The step up in basis is written explicitly into law and has been part of the code in various forms for over a century. It is codified, referenced in IRS publications, debated in congressional hearings, and analyzed in mainstream financial media. The IRS knows exactly how it works. Congress has reviewed it repeatedly. What it is, more accurately, is a structural feature of the code that produces dramatically different outcomes, depending on the scale and form of your wealth. And that is where the mechanics become important to examine honestly. To borrow against assets in the way the strategy describes, you need substantial assets to pledge as collateral in the first place. The securities backed lines of credit used by wealthy families, where a brokerage portfolio serves as collateral for a low interest loan, typically require significant minimum balances. Access to favorable interest rates, flexible terms, and high loan to value ratios is largely reserved for high net worth clients with established relationships at private wealth management institutions. For someone with a mid sized brokerage account, borrowing against it is technically possible. Margin accounts exist at most retail brokerages, but the interest rates are higher, the terms are less favorable, and the risk of a margin call, a demand for immediate repayment if the collateral loses value, is far more dangerous relative to the size of the position. What is a manageable and strategic financial move for someone with a $100 million diversified portfolio is a potentially catastrophic risk for someone with a $200,000 account. Scale changes the economics in ways that cannot be separated from the strategy itself. The version of this that works for the ultra wealthy is not the same instrument as the version available to ordinary retail investors. They share the same legal structure, but the practical reality is entirely different. The risks are real and deserve careful attention. If the value of pledged assets falls sharply in a broad market downturn, or because of problems specific to a single company, lenders can issue a margin or collateral call. That means demanding repayment or additional collateral, often within days or hours. If the borrower cannot meet that demand, the lender may liquidate the assets. A forced sale is still a realization event. It still triggers capital gains tax, and it often happens at exactly the moment when values are already at their lowest. Interest rates on these borrowing facilities are typically variable, tied to benchmark rates that shift with the broader economy. In a low rate environment, the cost of borrowing may be modest relative to the return on the underlying assets. In a rising rate environment, the calculation changes materially. The interest compounds. And if the assets are not appreciating faster than the cost of the debt, the advantage the strategy is supposed to provide begins to disappear. Concentrated positions create additional exposure. A founder whose wealth is mostly tied to shares in a single company faces a specific kind of risk. A single negative event, a regulatory action, an earnings miss, a shift in market sentiment can collapse the value of the collateral rapidly. Lenders typically impose lower loan-to-value ratios on concentrated positions for exactly this reason. The assets most likely to carry large unrealized gains are often the ones most vulnerable to sudden, sharp declines in value. And there is always the possibility that the rules change. The step up in basis has been a recurring subject in tax policy debate. Various proposals over the years have sought to reform or repeal it, to replace it with a carryover basis where heirs inherit the original cost basis rather than a reset value, or to treat death itself as a realization event that triggers capital gains tax at that moment. None of those proposals have become law as of now. But the political debate is ongoing, and a strategy that depends on a specific provision of the code carries the risk that the provision is eventually modified. Beyond the mechanics, this strategy raises a question that deserves to be taken seriously on its own terms. The tax code, as it currently operates, treats different forms of wealth by different rules. A worker pays income tax on every dollar earned from labor each year as it is earned. An investor pays capital gains tax when appreciated assets are sold. An asset owner at sufficient scale can potentially defer that sale indefinitely through borrowing, and then pass the assets at death with the accumulated gain eliminated entirely. The result is that the form of your wealth, not just its size, determines how it is taxed and when, and sometimes whether at all. Someone whose wealth comes from wages pays tax continuously and fully. Someone whose wealth comes primarily from appreciating assets may pay at a lower effective rate, on a deferred timeline, or in the case of unrealized gains held until death, may never pay on that growth at any point in their lifetime. Critics of this structure argue that it systematically favors inherited and asset-based wealth over earned income, and that it contributes to the intergenerational concentration of wealth in ways that compound over time. The ProPublica reporting in 2000-2001, which drew on a large collection of leaked IRS data, showed that a number of the wealthiest individuals in the country reported very low taxable income relative to the scale of their net worth, in part because the growth in their wealth took the form of unrealized appreciation rather than income, and because borrowing provided liquidity without triggering realization. Defenders of the existing rules argue that the realization principle serves a legitimate function, that taxing gains before they are converted to cash can force the sale of illiquid assets, including family farms, closely held businesses, and other holdings where valuation is complex, and forced liquidation would be harmful. They argue that repealing the step up in basis would create a system where the same gain could be taxed twice across generations, and that the right reform is not to add taxes but to reduce them elsewhere. Both arguments contain real substance. Neither is simply right or wrong. What they are actually debating beneath the policy language is what the rules should be, and what values those rules are intended to reflect. That is a legitimate and unresolved question. It is not a conspiracy. It is a policy disagreement about a structural feature of the code that has existed for a very long time. The strategy works not because someone found a hidden door. It works because the door was built into the system and left open. Whether it should remain open at this scale with these consequences is the question worth asking next. That is not a question with a simple answer, but it is the right question. And you cannot begin to ask it honestly until you understand the mechanism clearly, without the mythology, without the outrage, and without the false simplicity of calling it either a masterful trick or a criminal conspiracy. It is neither. It is a legal structure, operating exactly as designed, producing outcomes that are asymmetric by nature, and debated precisely because those outcomes matter. Now you understand how it works. What you make of it is the more important question.